Welcome to my channel. I'm going to show you step by step how to value a stock. We will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end, we calculate and analyze the financial ratios. I am doing this with you throughout the entire video, so it's like we're doing it together. I answer every single comment, so feel free to ask a question or let me know your thoughts. The company we're going to look at today is Brookfield Property Partners, and this is a commercial real estate company. Let's get started with the model. This company has a market cap of $11.1 billion. So that's the value of the company according to the stock market. Let's see what they're trading at. $12.04. So that's one share of stock. And the way you value a company is you estimate the future free cash flows and then you discount that number back to today's value. That's exactly what we're doing in this video. And now I'm pulling their actual free cash flows. And they have negative free cash flows in 3 of the 4 years. Now I'm going to pull the net income, which is the profit and loss on the income statement. And we'll put that into the model. And then we pull the revenue, which is the sales. That's also on the income statement. When companies invest a lot in their business, they might have negative free cash flow, yet positive net income, because when you buy assets like real estate, you depreciate those assets over a long period of time. But their revenue is increasing every year. It's going up about $1 billion every year, so that looks pretty good. Let's look at the capital structure. They pay $2.9 billion of interest on their debt. Let's go to the balance sheet to see how much debt they have. Current debt of $9 billion, that's debt due within 12 months. Long-term debt of $47 billion, that's debt due after 12 months. They're structured as an MLP, Master Limited Partnership, so they don't pay taxes. Let's get the cost of equity. We need the beta. That's how volatile the stock is relative to the market. And that beta is 1.56, so the stock moves about 1.5 times the market. Let's get their current assets. We need this to calculate the current ratio later. And current assets are assets that can be liquidated into cash within 12 months. And that's $3.3 billion. And let's see what that is. $1.4 billion of cash, $500 million of net receivables, and $300 million of other. Let's get their current liabilities. That's $12.5 billion. And let's see what that is. $9 billion of current debt, $5.5 billion of accounts payable, $342 million of deferred revenue, and $547 million of other. And like I said earlier, they're structured as an MLP, and MLPs don't have equity. So to plug in a number for equity, I just took their total assets, $111 billion, minus their total liabilities, $66 billion, and that's $57 billion. As I said earlier, a big benefit of being an MLP is not paying income taxes. But in order to qualify to become one, you have to receive 90% of your revenue from natural resources or real estate, and this company does through real estate. Also, MLPs issue units instead of shares, which is why they don't have any equity. But I had to plug in this equity number just to figure out the discount rate for the model. Let's get their EBIT, earnings before interest and taxes. That's called operating income on the income statement. That's $3.7 billion. Let's look at the capital structure. They have 49% debt. Cost of debt is 5.26%. 51% equity. Cost of equity is 14.3%. And the WACC is 9.85%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4. That's up here in blue. Then we discounted these numbers back to today's dollars. And we get a value for the company of $7.2 billion. We divide that by 922 million shares, and we get an intrinsic stock price of $7.81. It's trading at $12, so it's trading at a 54% premium. So it's a sell according to the model. But simply Wall Street has them at intrinsic value. They value the company at $11.61. And the way they value companies is they take the average analyst estimate. So the stock has been trading much higher for several years, but when coronavirus hit, it really dropped and it hasn't come up too much either. Let's look at the financial ratios. Really good PE, really good price sales, and amazing price to book. So PE is stock price over earnings per share. To get earnings per share, That's net income over shares outstanding. I like to see a PE below 15. They're at 3.5. So investors are paying $3.50 for $1 of income. This is a really good ratio. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 1.4. So investors are willing to pay $1.40 for $1 of sales. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. And this is an amazing ratio. They technically have no equity, but I had to come up with a number, so I'm not sure how accurate this is. They have a bad current ratio, interest coverage ratio, and ROE. Current ratio is current assets over current liabilities. They can't even come close to covering the current liabilities. ROE is net income over equity, so they don't provide a good value to their equity holders. And interest coverage ratio is EBIT over interest expense, so they can cover their interest expense just by a little bit. Some of the ratios look really good and some look really bad, so it's a judgment call. What do you think about this stock? Thanks for watching the video.